Welcome to the CFA program Level 2. This is Nick at Quartic with 10 topics in 10 weeks. We reach the culmination of our analysis here. Within the 10 topics, we've got three main areas. We start off with the analytical tools. You've got the quants, the economics, the accounting, the corporate finance. We apply those tools to asset valuation, and we have equity, fixed income, derivatives, and alternatives. We're now taking those asset valuations and we're putting them into a portfolio. So portfolio management, if you like, is the culmination of all our studies on the CFA program. Within portfolio management, there's a lot to cover. Many years ago, this was a very short extension to level 1. This is now a major area for study. We've got 6 readings, 10 to 15%, up to 18 questions in your exam. And most of the readings are quite challenging. So we begin with actually a fairly straightforward one: exchange traded funds, ETFs. What are they? How do they work? Couple of calculations on them, but overall a reasonably straightforward description of a very commonly used investment vehicle. Using multi-factor models, we have seen how multi-factor models work in quants. We're now applying them, in particular the Carhart model, which is variation on Fama-French. If you're not familiar with the Fama-French model, you will be, trust me. So how do we do attribution analysis? How's a portfolio performed over the year? How much of it is due to different attributes of the portfolio, and how much of it may be due to the actual stock picking skills of the manager? We do risk attribution as well, but that's quite a technical reading. We then move on to market risk, measuring and managing market risk. We look at things like value at risk, and we analyze that in a number of different ways, 3 different ways. We talk about other market measures. We know within the equity markets, you've got things like your beta. In the fixed income markets, duration and convexity. And in the derivatives markets, you've got things like your option Greeks. So quite a wide range there, and various other models as well. A detailed but not that difficult reading. Moving into the second study session, economics and investment markets. This is quite complex. The basic idea for part of it is actually simple, which is we're doing discounted cash flows. That may seem very simple until you say, what are the different components of the discount rate when it comes to things like inflation, inflation uncertainty, and various other aspects of risk? Once you break it down, it becomes a little bit more complicated. We also analyze the yield curve. So there's quite a bit of fixed income. There's the economics behind the yield curve, and quite a detailed chapter. Then we move into analysis of active portfolio management. If the market is perfectly efficient, then active management doesn't achieve anything. But the market is not perfectly efficient. So how does active management work? We look in particular at the Sharpe ratio, at the information ratio, and how those two interact. We look at other theories of how we can determine the level of active risk and active return dependent on a number of different factors. Lots of calculations here. Quite a challenging reading. You're going to need to spend time on that. And we conclude with a fairly short and simple reading: trading costs and electronic markets. Yes, there are a couple of calculations here, but we're describing, first of all, what the costs are of trading. We break that down into direct and indirect costs, and you'll see a few numbers in that. And then algorithmic trading and high frequency trading. What are the basic concepts there? What are they adding to the market? Are they good or bad news? And that wraps up portfolio management.